Welcome, guys, to today's first day of our boot camp. Um, Give me 1 second here. We need to get to the first page. Okay, so this is the official first day of the 5-day boot camp. I am your host, Sauce, and today we're going to uncover the basics of the market. We're going to go over a lot of different topics in the market, but most importantly, I want to give you the basic understanding of what it is to trade Forex and understand price action, understand market structure. So all of these things that you will learn from this 5-day boot camp will be as followed here. So what you're about to learn, here we go. Here's the first understanding of it. What you will be learning, for one, is how price actually moves. I want to be able to show you the actual price actions because the market only moves in three different ways. It's either it goes bullish, bearish, or consolidation. Those are the only three ways that the market moves. And when you understand the three ways that the market moves, you're able to capitalize or know when to sit on your hands and not take action. Next, I want you to understand, I'm going to help you understand how the institutions think, not in the sense of we are the institutions, but how they think in the sense of the way they set up traps, liquidity that gets built up in order to sweep for them to make the move that needs to be made. Third, I want you to understand market structure. Out of all the things that I've said, the most important one is market structure. Market structure is like the skeleton. It's like the skeleton of the market. It's like how our bodies have skeleton, which our skin sits on, is the same thing for the market. If you understand market structure, you will understand everything else about the directions of the market. Even if you take a bad trade, the fact that you have the proper market structure, you'll still have some realized gains before you get taken out. That's the that's the benefit of market structure. And lastly, I want to help you understand how to avoid making some beginner mistakes. And I'm not speaking on the psychological side, beginner mistakes like taking trades with retail traders and retail zones. Some of these terms may not make sense to you right now, but later on in the week, as you start to learn and understand where retail traders takes their trades, then you will understand why in certain areas, even though it looks like a good opportunity, you will avoid that entry simply because you know this is where retail traders are most likely going to enter, which 9 out of 10 is the liquidity that the institutions are building. Now, what to not expect from this boot camp is that this is going to be some sort of a signal group where I'm going to be giving you signals throughout the week of what's going to happen the next day, the next session. That's not what we're doing. This is not a shortcut system where you're going to look for a shortcut to get to the market to be able to understand how to make money overnight. It's not a shortcut. You're going to have to put the time in to actually learn the skill. And lastly, as I said, it's not a get rich quick promise. It's literally understanding, giving yourself the discipline and understanding to put the work in. It's not difficult. It really isn't. It's all pattern recognition. But when you put the time in to learn and see that the market does the same thing every single day, you start to recognize it over time. You start to see it. You'll recognize, oh, this happened already. I've seen this. I've seen that. And it starts to make more sense to you. Now, some of the few things that we'll cover, such as the price action, um, for those of you who are very, very beginner in understanding what price action is, it's simply a battle between the buyers and the sellers. And you're trying to see who is more in favor in order for you to see which direction you're going to take your trade. If the buyers are in favor, you're going to see bullish price action, such as right here. If sellers are in favor, you're going to see selling price pressure. And with market structure, it'll allow you to understand when and where to take your trades. I also want to give you a better understanding of the candles and how to understand who's winning during the period. Candlestick anatomy, for example, is what it's called. Being able to read the candles, individual candles, and seeing what is the story that is telling you. All right. For example, here you can see I want you to also understand when you see candles, and you don't want to just see candles, you want to understand what is it that you're seeing within these candles. For one, let me fix this here. For one, when you see the candle, you need to understand that what a body is. This part of the candle, the entire green section, for example, that's the body. The line above it is what you call the wick. The wick is the rejection of the opposite direction, pushing the price, pushing against it. So when you have the body, which is the price movement, in this case, you can say being in this bullish, this push that's happening here. You can see strong buyer control. But what do you see here? The wick, the rejection is the sellers trying to push against it. So understanding a little bit about the candles and how they represent the strength of who's in control versus who isn't. Same thing you can see on this side, the bearish push. Now, there's a thing that's called OHLC, which is the open high, low close. That's just how the candles begin. The candles will begin at an open high. Depending on the control, it'll close most likely. That's how you'll see it. It'll open high, low close. That's basically what that term means. Open high, low close. That's how you read and understand the candles. We'll dive deeper into that when we get onto the screen. This is just me giving you a basic preparation of what we're about to go over throughout this week. Next, what I want to cover, we're going to cover is the market structure in a more in-depth example. We're going to understand higher highs and higher lows, which represents a bullish. Higher highs and higher lows represent a bullish price action. Lower highs and lower lows represents a bearish price action, i.e. a bearish trend. Higher highs, higher lows, a bullish trend. The structure shows the trend, not the emotion, as you see. Okay? Well, as I said, we'll dive more into them once we get onto the screen. Next, I'm going to also dive deeper into change of character. What is change of character? What does it represent? A change of character is simply that first sign that the market gives you when things are about to go the other direction. If it's been going bullish, you've been seeing higher highs, higher lows, higher highs, higher lows, and finally you see a change in direction, and I'll show you how that looks like later on. That's just the first sign that the market is giving you a warning that, hey, we might be turning around. This is your chance to be noticed and to position yourself for when that shift happens to get on board. That's what a change of character is. It indicates a shift in control. Okay? As you see, it comes before the trend change. So we're going to cover change of characters. Another thing I want to go deep and cover with you guys is understanding the dealing range. These are all important factors when it comes to understanding where and how you're taking your trades. You don't want to take random entries. You need to know the dealing range, the equilibrium of the price. An example I can give you is like is like a iPhone. When an iPhone is new and it's very expensive, a lot of no a lot of people are not buying it. It's too expensive. But when the phone comes down to a moderate price, more people are buying it because it's affordable. And when the phone gets outdated and it becomes very cheap, not a lot of people are buying it because it's outdated and it's cheaper. So when you think about dealing range, similarly, the institutions, they like to operate within the equilibrium, within the 50% range of the market. So that equilibrium lies within your market structure, which we will discuss further on during the week. But I just want you to kind of get an idea of some of the things that we will discover and we will uncover today, this week. That's going to help you overall understand what you're doing in the market, because each one of these specific topics are very important, are key to understanding why you're taking a trade, when to take the trade, and where the market is operating.
Yeah, some people at your jail locked in with that shit. Nah, some nigga on Telegram just hit me up. I know he be really smacking shit. That's why I fuck with Brady. He be with E-Man Ghetto. You know E-Man Ghetto?
Guys, let me mute your
Just know he be with this nigga right here, homie.
let me mute your yes,
Just
let
know
me
he a big dreader. He be a Warp 10, Autumn Boys, Money
move
Square.
real quick because
There's no kid like up, homie.
hold on a second.
This nigga right here. You know them boys be smacking shit, homie. Well, them boys making like millions, bro. Yo, Marv, them boys making millions.
Okay, how do I mute everyone for now? Okay, it's in the chat. There we go. Guys, can you mute your it's not giving me the choice to do that right now. Okay, let me continue. Okay, so next, as I mentioned, is the equilibrium, as I said. So we'll uncover that as well. And I also want to go over supply and demand. As I said, you'll understand, I'll give you a better understanding of what supply and demands are. Supply and demand is something that people see all the time. You see it all the time in the market, you see it everywhere. So it's very important to understand where the right supply and demands are and the wrong ones. So you may say, wait, there's a right or a wrong? Of course, because some supplies and demands are where retail traders' liquidity, their traps are set. Their smart money traps, all these different things you'll learn later on. But for now, this is something that we will also um, cover during the week. And I also want to go over the routines of the institutions. There's something called a daily cycle. I want to go over the daily cycle with you, discover that so you can understand how price action moves from Asia range, from Asia session to London session to New York session. That's basically how the institution builds all of the liquidity throughout the Asia session and collect them throughout the end of the day, which is the New York session. And last, another thing you're going to walk away with during this week is understanding how to manage your risk, how to stay in the game for the long run, not blow your accounts, not waste and lose all your money. So I'm going to teach you how to properly risk along with how to get the reward. So you're going to be more of a risk to reward trader, not a win rate trader. It's not going to matter if you have a 30% win rate. You will still be profitable with a 30% win rate over 80%, 90%. You don't need to have that high win rate with this way of understanding the market. You just need to have 3 out of 10 trades correct and you'll still be profitable, literally. So we'll go over that as well. And there's only 4 steps of trading. You literally just analyzing, you plan, you execute, and then you review, which is the journaling, which at the end of the boot camp, I have a PDF for you guys that I'll provide you with. This PDF is going to allow you to journal. It's properly created to where you just have to select and then type in the things that you need to improve towards the end of your day, which I'll explain when we get to that point towards the end of the week. Overall, this is what we're gonna uncover, and I'm going to leave you guys with this little homework towards the end of the session, which is just basically for you to review over what we go over today, and as well as taking notes on what the market will be doing throughout the day, tomorrow, and so on. So without further ado, let me jump over to the chart and let's dive in. Let's dive into let's dive in. Okay. Okay. Let's stop sharing this screen here. Okay. Okay. Now let's begin. Let's begin. All right. So first thing first, let me okay, perfect. Okay. First thing first, guys. Let's start off with understanding price action. So first thing first, let's dive into, let me put a text up this here so we can understand. And make sure you guys are taking notes on this because this is where the understanding of the market begins. Okay. So first, we're gonna touch on market structure because without market structure, you do not have anything. Market structure. Okay. So let's understand market structure. So as I said before, when you see price actions that looks like this, where the market is pushing up, let's first give you the terms. Okay. Now, when you see this right here, this is what you call a bullish price action, for example. And this is a series of higher highs and higher lows. And you want to know this because when you see this in the market, you want to mark this out. So you want to see this is a low, because this is the beginning point. This is a low. This is a high, because this point here, this low point, led to this point, this high. Okay, so we're going to mark this as high. Now this point where price retrace comes back down here, this is what you call a lower high. It is a lower high because this point is lower. Hold on, it did not. This low is higher than this low. So I'll repeat it. This is the beginning point. This is your low. Price came up here. This gives you a high. It pushed up. So this is a high. Price then retraced. But when it retraced, it did not come lower than this point, than this low here. It did not come lower than it. So that gives you what's called a lower high. So now price then pushed up here. Now this gives you a higher high because this high is now higher than this previous high. So now you've got high, lower high, higher high, same thing again. Higher high, lower high, and it continues. So this is your bullish market structure. As we said earlier, a bullish market structure consists of higher highs and higher lows. And a bearish market structure consists of, my apologies. The bullish market structure consists of higher highs. Excuse me, cold is getting back into my. Okay. So yes, so the bullish market structure, you're gonna have higher highs and higher lows. So I miswrote this one. My apologies. Higher low right here. So yes, so you have a low, you have a high. You have a higher low because this low is higher than this low. So same here. So my apologies. It's not lower high, it's higher low. That would be for the bearish market structure. So you have a low, high, higher low, higher high, higher low, and it continues again, higher high, higher low, etc. And this is basically understanding market structure when you're in a bullish trend. This is a bullish trend, okay? So if you're trying to understand, well, when the market is in a bullish trend, how do I know if I'm in a bullish market? How do I know if this is a bullish trend? You look for series of this, higher highs, higher lows. You want to see price reach a point. It's a bit choppy. Is my, can you zoom in? It's kind of hard to see. Okay, okay. Let me zoom in. And someone says also a bit choppy. Is it better now? Is the zoom in better? Or do you need me to zoom in some more? It's better, okay. And the choppy part, is it my voice or okay. If it's something else, it's the connection. Ah, I see. Um, okay, let me see. Let me turn off this monitor. Allow the one second. Let me adjust my Wi-Fi. That will probably with the signal. Okay. Okay. So it should be better now. I switched over to the Wi-Fi. Okay, so to give it clarity, this right here is our bullish trend. This is a bullish market. Okay. This right here is your bullish. So if you're trying to understand when you're in a bullish market, this is your example. Now, for a bearish trend, let me see, I'll put them next to each other so it's easier to see. For a bearish trend, you have the opposite. What you have is price action going down, retracing, down, retracing, same as your bullish one, except it's going the opposite direction. And this will be your bearish price actions. And what do you have? Similar. You have a high, then you have a low. Then you have your lower high. And as we've said before, why is it a lower high? Because this high is lower than this high. So it becomes a lower high. Let me make sure I can see you guys' chat in case. Okay. So this becomes your lower high. So you have a high, low. This high that fell to break above this high now becomes the lower high that leads to this lower low, because now this low is lower than this low. So now that's your lower low. And that's just how it continues in that pattern. Lower high, lower low, lower high, and lower low as such. So this is just the basic movement of price action, the basic market structure that you need to understand right here. This is your bullish and this is your bearish. Okay? It's nothing more than that. This is your bullish price action and this is your bearish price action. So if you're in the market and you need to know, hey, what is the current price action? Where am I in the market? What is happening? You just need to know, where do I see low, high, low, high, higher, high, higher, low, higher, low? I'm in a bullish. If I see high, low, high, low, high, lower, low, lower, high, lower, low, I'm in a bearish. Once you know that, if you see you're in a bullish, you know you're looking for buys. If you see you're in a bearish, you know you're looking for sells. It's pretty much that simple. I'll show you a quick example for context. So we're going to try to do theory and then also see it on the chart as well. Basic understanding. If you look at the chart here, what do you see? The same basic thing we've just discovered. What happened here? We can see this was a low. Use a darker mark highlighter. This was a low. This was a high. This became a lower high. A higher low, my apology. This became a higher low because this low is higher than this low. And this became a higher high up here because this high is higher than this high. Then this became a lower high once again. And this became a higher high once again. A lower high, and it just continues as you see. Higher high, low high, higher low, higher high. So that's what we have. We have a low, we have a high. We have a higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. And that's just the basic of how the market moves when it comes to price action and market structure. Now, understanding this alone when it comes to market structure will save you 50% of bad trades, because this alone will let you know where the market is going because of the three phases of how the market will move. This right here is the beginning of the first phase of getting to where it is you're going to take a trade, or what type of trade are you taking. Are you going to be taking a trade to lead you to create the next higher high, or are you going to be taking a trade to come fulfill this retracement? But we'll go over the retracements and those topics later on. So when you hear some of these terms that I bring up now, it's just to get you familiarized with them. So when we do go over them, you understand a little bit of it. So now that you understood, I gave you the understanding of this market structure. Now let's go over the next thing, which is change of character and identifying the shifts in the market. So let's see. So let's say we have a bearish price action. And I'll zoom in because I know you guys said it's not so clear. Okay. Okay, and I'm going to pause it right here. Okay, so hopefully you guys can see it is clear here. It's not the best drawing, but it'll get the job done. So right here, what do we know? We can see that we have we're in a bearish price action right here. We're in a bearish trend, right? Because all we see is high, low, lower high, lower low, lower high, lower low, lower high, lower low. That's all we're seeing so far. So we know we're in a bearish price action. So once the last low, for example, in this case, when a change of character happens, how you identify a change of character is this. You want to see where was the last lower high that led to a lower low. First, that's the first thing you want to ask yourself. When was the last, what was the last lower high that led to a lower low? In this case, it was this one right here. So if this high led to this low led to this high that did not break this high, and then it leads to this lower low, then another lower high right here. So we can see that the trend has been respecting, excuse me, the trend has continued to respect this pattern. So once we see that out of nowhere, the market all of a sudden, out of nowhere, the market just decides to give you this shift here. My mouse is tweaking. Okay, so the market gives you this shift here where it creates a higher high. Instead of giving you a lower high, it creates this high, this move right here. And I'm going to mark it for you right here. When the previous lower high, this one here, that leads to this lower low, comes back and breaks above the previous lower high, that's your change of character. Like I said in the beginning, that's when the market is giving you the first sign of, hey, there's going to be a shift. Okay, that's not big, and let me make it larger. That there is going to be a shift in the direction. Okay. This right here is your clear sign that there's going to be a shift. This is what we wait for. We wait to see we get a change of character. Once we get our change of character, we then allow the market to give us confirmation. So this, for you to understand, this is your basics of change of character. So if you come in the market and you see that it's already a bearish trend like this, or a bullish, in this case, for example, I'll flip it like this would be bullish. If the market is moving in this bullish trend right here, and you see this low that led to this higher high, then comes down and take out the previous low that led to the higher high, that's your sign that there has been a change in character, that the market is no longer moving the same way. It's acting a bit different. Before we were moving in this rhythm, high, low, high, low, high, low, and we were never breaking the previous lows. We were respecting those previous lows. All of a sudden here, we didn't respect that previous low. We broke under it. That means that price wants to come down somewhere in these areas. So this is where we start to position ourselves to take those trades. Now, is this enough for us to take a trade, just a change of character? Not really. The change of character, like we said before, is just the sign. That's just the market giving us a warning to say, hey, there's about to be a shift in the direction. Where has been the direction? Let me flip it back. The direction was bearish. We were in a downtrend. The market just gave us a sign, a signal that, hey, we're about to go bullish for a moment. And this is where you catch that movement, that signal, and you say, okay, for the market to confirm that this is going to be a bullish momentum, I need to get a break of structure. This is something that we're also going to discuss, but for now, we can add it into this pattern. Now the break of structure becomes the next move. This is what we wait for to confirm our bias. Now, once we get this break of structure, now you have a change of character and a break of structure. Now it's been confirmed that price is going bullish. Now you can wait for whenever the market returns back into the equilibrium. Remember, we spoke about equilibrium earlier, letting the market comes to these dealing range, which we're not going to uncover that today. But when it comes to dealing range, I'll explain that on a later in the week where it makes more sense to you. The equilibrium of this range from this low to this high, price needs to come back to fulfill a balance. And this is where we would find our trades, our entry models, our opportunity to then take a buy to push up with the market. where it'll be safe, it'll be high probability, and it will be with the pro trend of that move. So this is your understanding of, excuse me, this is your understanding of change of character to a breakup structure. It's pretty much that simple. It's nothing so um too deep. Same thing for a bullish price action. Our market is moving bullish. The low leads to this high. The high comes down, sweeps the previous lower high, causes a change of character, then gives you a retracement, then gives you a breakup structure. At that moment, you know that you're good to take sells when price retrace back into your zone. Okay? So that was the market structure, understanding of the higher highs, higher lows. Now I want to quickly go over the trading range, and then I will give you the premium and discounts, and then we'll take a break from there. But first, let's go and see that on the chart. As we said, we're going to do theory, and then we're going to look at it on the chart as well. So let's see on the chart. What do we see here? Let's quickly go to current price action. Okay, let's find a trend. All right here. So we had a bullish trend right here. Let me know if it's clear. We had a bullish trend. We had low, then we had high, then we had higher low, and then we had higher high because this high is higher than this previous high. Then we had another higher low because this low is higher than this low, so it's a higher low. Then we had this other high, higher high, because this high is higher than this high. Continues, higher low, and we can say higher high here. Higher low, higher high once again. Higher low, you'll see it's literally the exact same things we've broken down. As you can see, this has just been a bullish trend. Bullish, bullish of what? Higher highs and higher lows. Price is respecting the higher lows. No higher lows has been broken after creating a higher high. As you can see, the market was following that trend, respecting those higher lows. Until what happened here? We created this high right here, and then it came down and took out this low. This was a sign that the market told us, hey, we're about to shift. Because right here is where we change characters. We've immediately changed character right here. So this is the basic understanding of price action. Just like we spoke about. This is the market giving you a sign that we are going to change in direction. So as soon as the change of character happened, the next thing that confirms the move for you is now the break of structure, which you got here. From this lower high, from this lower low, you got this higher low that then leads to this lower low once again. So now you've got this break of structure here. And what happens, as we said earlier, after the break of structure, the market will come back and it will give you an opportunity to get into the move, which in this case is the sell. Because we were bullish and now we've given you a direction that we're going to come to the sell. Now, just by seeing this, I want to now help you understand the trading range. Because now, by understanding the basic of change of characters, break of structure, and knowing that this is the setup that we want to see in order to take a sell or a buy from, right? Even if this was flipped, it will be the same. It will, if this was in a sales, if this was coming in a sales trend like this, and then it reached a low and finally price broke above it, changed character here, broke structure here. This is the region where you want to take your buy from. So let's flip it back. Now I want to give you a better understanding of the trading range, because that's what's going to allow you to better position yourself for the trade. So here's what the trading range is, or the dealing range. When it comes to the dealing range, let's say you have a price action like this. This high, let's do this low. Then this zone, and then it comes right here. And then you get, let's say right here. Okay. So this was a high. Let's put some text for visual. This was a high. And this here is a low. Now, between this high and this low is where you're looking for your dealing range. Everything in between this range here is what you call a dealing range. And the equilibrium is simply the 50% of this range. So institutions, the banks, the big money, the ones that likes to make, that pushes the big moves, they operate within these areas. They're not going to try to flood a large sum of money into the market at 20%, 30% of the range. They're going to do that. The move that's going to cause the break to the next leg is going to happen from the 50% range, or the 0.68, 686. So how you define that is with your Fibonacci tool. Now, for those of you who are very, very new and don't really know the Fibonacci tool, I'll give you my Fibonacci settings as well, so you can better understand how to position it. So this, for example, is your Fibonacci tool from this high to this low. If you're in a bearish trend, you want to use the Fibonacci from the high of where you're coming from to the low that the market reached before the retracement. Not this low, not this low. You do the first one, depending on what dealing range you're trying to figure out. In this case, let's take a look at this first dealing range right here. Okay, so let's create more. Okay. Okay, so we know that this high led to this low. Then it retraced up to 50% and higher. It went to the 618, the 618 premium range, where institutions like to be involved, and then push the market down to create a new leg, which what gave us a break of structure, we could say. This gave us a break of structure. Actually, I'll type it. Now, this break of structure here, excuse me, I think this was the wrong one. This break of structure, now price needs to retrace, come back to that zone. Come back to that zone and give us a reaction. Now, if we take, whenever this happens, let me give you more clarity. Whenever this happens and price creates a new leg to the downside, you now have a lower low and a lower high. So in this case, this becomes a lower low, right? Because we're in a bearish trend. So this becomes a lower low. And this now becomes a lower high, because this high is lower than this high. Okay. So now let's just say this is not, let's not even call it a change of character yet. A break of structure. Let's say this is the change of character to begin with. Let's say this is your change of character. Now, we know that we've already identified that the trading range was from this high to this low. Price came back to the equilibrium, the 50% range, or at least or above, as you can see here, above 50%, and reacted from there and push down to create a new leg to the downside to show the intent that this is the direction the market wants to go, at that point, we can say, okay, we are done with this trading range. This trading range has been fulfilled. Now, the next trading range that we are in is now this low and this high. This is your new trading range now, because this one from this high to this low, it's already been fulfilled. So now you're dealing with this is your dealing range. So let me put that in the title so we can understand. Dealing range. Okay. So now you do the same thing with your Fibonacci tool. You can say, okay, from this high to this low that the market reached. And what you see is that the market has not reached 50% of this equilibrium or the 618. So in this case, you can almost guarantee that the market will continue to push up from here. This retracement will continue up until the market reach these areas, within this area, before it pushes down again to give you a new leg to the downside and give you another break of structure. Why? Because it hasn't retraced to 50% or 618 or the 786 range. These three, if you, I'll give you this as a pointer. Remember earlier I said some supply and demands are wrong, or they're not correct ones. If you see a supply or here, for example, that's sitting within a 0.382 range under the 50%, it is more likely going to fail. It is going to be a trap that price is going to use as a smart money trap in order to fulfill these levels and then make the move to the downside that the market was intending to do. So you see, when the market came to this equilibrium, it fulfilled the 50% and it led to this break of structure. When it retraced to this zone, it did not retrace to 50% and it still broke structure, but now that's where the trap is built. Because you know that price broke structure of this low, you're expecting the same thing that's happened here, where the market respects the previous lower high to respect also this lower high. But the market comes back and takes out this lower high to fulfill this 50% 618 region, while this is still respecting market structure. This does not disrespect the market structure, because now the market structure simply becomes this. This becomes the lower low, and this becomes the lower high. And this just becomes what's called internal structure, which we'll speak on later on. But this becomes what you call internal structure. And you still have your break of structure here, yes. But that retracement that you're going to take your trade from will not be from this one. Even though this was the one that gave you the break of structure, it won't be from this one. Simply because it was not within the the premium range. Same thing if you're in a bullish market, and price gave you this change of character, gave you this break of structure, and this previous higher low did not come down to 50% range, and the market is retracing back to it, chances are it's not going to stop here to react from here and push down. It's going to come through, take out this zone, and all of the retail traders who are going to expect that the market will respect this zone because it broke structure, but that's not the case. Smart money, that's how they think. That's why I say I want to help you understand how the smart money think. Because for them, it's all about setting up traps. They understand what the retails are looking for. They understand what the common thought process are. If there's a change of character, a break of structure, everyone knows that the market must respect structure. And if there's a change of character, break of structure, The market can't do this, change character, break structure, and all of a sudden do this. Go all the way up here like this. It can't do that. It's just, it does not align with the market structure. In order for the market to do this right here, it would have to have done change of characters internally, broken this structure, retrace, back again, retrace, back. It's a process. It will never just shoot right up like that. It's impossible. But what it will do is come into the zone, mitigate where it left an order block, and then push down. Okay? So this is understanding the dealing range. Let me give you a chance to see my fib tools. If you need to take a screenshot of it, go for it. And this is pretty much what I use. Literally, nothing different in the coordinate. Everything stays as normal. And these are the range. These are the ones that I use in that format, okay? So now, let's go see it in theory, okay? So now let's see it on the chart. The same things that we speak on, you'll see the same things happening on the market, okay? So let's see, recent price action. We could do it right here. So we had highs, low, high, low. Okay, what happened here? We can see that the most recent dealing range, we can see that we came from this high. Price came down to this low. This was our dealing range. We want to take out our fib tool and we want to see, has the market retraced back to equilibrium? And if it did it lead to a breakup structure? Okay, what do we see here? Very clean, very clear. The market came back above 50% and pushed down. And what lies within that range? Very easy, very simple, easy to see order block. And we will go over order blocks as well this week so you can understand what an order block is. But as you can see right here, a very clean, clear supply right here within the premium zone, right at the 50% for price to react from and lead to a breakup structure. Same thing. So now that this has happened, let's go down to the next equilibrium. Let's see. Okay, so we've completed this. We fulfilled this range. What's the next one? We'll go from this range to now this range. We're going to ask ourselves, as price came to the equilibrium of that range as well. Okay, so price did above 50%. Remember, institutions likes to react above 50%. Anywhere above 50% is enough for the institutions to react. So what happened here? Above 50%, what did the market do? The market came through, reacted from a supply again, caused another breakup structure. Okay, let's continue. The next one, this range, and this range. Let's see, did we do the same thing again? This is literally how the market moves on a daily basis. What did price do? Price came above 50%, slightly above 786 because of these this looks like we must have had a news candle to fulfill deeper levels, and then now it's pushing down. Now, does that mean that price is pushing down to create a new low to the downside? Perhaps, but that's not us to decide because the market already told us, right? From right here, we could see this high to this low, this high to this low gave us a change of character. This high to this low gave us a breakup structure. So what is the market telling us now? This internal movement was bullish to come up here. Now it gave us that first warning of the change of character right here, saying, hey, this internal movement we were doing is coming to a stop. It's coming to a stop. And now we also got this breakup structure following right after. So what does that tell us? That we should be looking for sells. So This is the basic understanding of the dealing range, okay? The dealing range. Now, within the dealing range, you have something called premium and discount. This is the last one we're going to cover, and then we're going to take a break. Within the dealing range, as you see here, we have something called a premium and a discount. Premium is when price is retracing to the higher side of it. So this right here would be what you call a premium. When price is expensive, when price is high up here, this is a premium price. Okay, when the market is coming up to the high side, so if you're in a retracement to sell, when you're looking to sell, you want to sell from a premium zone. You don't want to sell, let's say you're in this area, for example, you don't want to look for a sell when you're here under 50%, because this is already a finished move, because pretty soon it's going to break structure and have to retrace again. You want to sell from premium, which is above here. Premium is 50% and above when you're looking for sell. When you're looking for buys, it's the opposite way. It's discount. I don't know what just happened. Hold on a second, guys. My Zoom just glitched on me. Give me 1 second. I don't know what happened. Let me get it back up. So far, we've covered market structure. We've covered bullish. We've covered the trend. So you guys have an understanding, a better understanding of that. We've covered change of characters. Okay, here we go. Let me now share the screen once again. And now we're just going to finish the premium and discount, and then we will take a break. Actually, we might be able to just go straight into the Q&A. Okay, here we go. Okay, cool. So as I said before, when it comes to taking a buy, you don't want to take a buy from a premium range, meaning you don't want to buy the market when it's already up here. If you're looking for example, if you're trying to buy I don't know, let's use some shoes, for example. You're trying to buy a pair of sneakers. If the shoes is expensive right now, or let's use a better term, television, because the price of television fluctuates. So let's say you go into the store, you know that right now this 75-inch TV costs $2,000. And you say, man, this is expensive for this television, but I know that by Black Friday, this television is going to be half the cost. By Black Friday, this television is going to be way cheaper. Same thing here. You know that if you take a buy from here, the distance that you have until you break structure again, from right here, until you break structure, which is right here, you break this structure, before price have to retrace again, is very low. It's a very small window of opportunity, in comparison to if you take your buy from way down here and your next place of breaking structure is way up here. Now look how much more you get to gain by taking your buy from a discount range versus taking it from within the premium. So what would that look like? As we've said, premiums, when you're in a buy zone, when you're looking for a sell, this is what you call a premium within your dealing range. Remember, it's all within the dealing range. And the discount is when you're looking for a buy. So when you're looking for a sell, you sell from the premium. When you're looking for a buy, you buy from the discount. So when you hear the term, someone say, I'm waiting for price to come to discount, understand that they're waiting to take a buy. They're waiting for price to come to a cheaper place so they can buy the market. If you hear the term buy low, sell high, that's kind of what that aligns with. You're waiting for price to become cheap so you can buy the market. Same way you're waiting for the market to reach a premium where it's too expensive to then sell it. Like when you own a piece of jewelry or you own a piece of value and it goes high in value, this is the time where you get to sell it because now you get to make profit by selling it because you've made a lot of profit from it. So that's why people sell when the market is high because nobody's going to keep buying it high. So they have to sell in order for the equilibrium of the market. So that's the understanding of premium and discount. Okay. The last but not least, I was gonna do this after the break, but it's not a deep it's not a deep topic that I can just do it right now, and it'll help you guys put it all together. Now, there is something called a swing high and swing low. Earlier, you heard me say the term internal structure, which, let me bring this back actually. You heard me say something about internal structure. Swing highs and swing lows is basically this. Actually, let me just take all of this out. Whenever you have swing high, swing lows. So this is very important because this also works in market structure. So when you have this high that leads to this low, that leads to this lower high, that leads to this lower low, leads to another lower high, lower low, then you might get some internal price action like this. The market does not always move in perfect lines. So you may get some strange price actions like these. That's where it gets a little complex for most people, right? So now, this is where you need to understand swing highs and swing lows. The swing, so when you're marking out your market structure, you want to focus on the swing highs and the swing lows for your structure. So in this case, if I'm marking out market structure, I want to focus on for example, in this case, the high, then the low that it led to. Then I want to find the retracement high that it led to, which will be this lower high. Then I'm going to find the next lower low. Then I'm going to find the next lower high. But these parts are quite easy. Why? Because there's no internal structures yet. This looks like a straight shot. So this is very easy right now. So you want to find the next lower low. Now here, you say, okay, this low led to this internal high. This is another lower high. Now, can we say this is now the lower low? We cannot, because this is not the swing low, just like this is not a swing high, a swing lower high. This will be the one that you'll mark as your lower low. because all of this price action within this equilibrium is simply internal price action. Okay? This is very important that you understand this because this can confuse you with your market structure and have you believe that price is trading within this range when really you're trading within these two range. This lower low led to this lower high. These became internal price action until this low gets broken. Once this low gets broken, that's when you identify your swing low. Until that happens, you just have a swing high and you don't have a swing low yet. And then you continue with the same narrative. This becomes your lower high, your lower low, your lower high, your lower high, your lower low. This is not your lower high, none of these, because this is your lower high, because what you're seeing right now is from this high that led to this low, right? That led to this low that broke under this structure here. This was where the break of structure happened. This was another BOS. When this happened, price must retrace. So write this in your notes right here. Whenever the market creates a break of structure slash BOS, price must retrace. Okay? Whenever there is a break of structure, the market has to retrace. It's always going to retrace. So as you see here, every single time we've broken underneath the previous low, the market has to retrace. So this is the reason why I say the market moves in three different ways. In the beginning, I say either moves bearish, bullish, or consolidated. So same thing that happened here. We've broken structure. This high led to this low, broke this structure. What must happen? Market must retrace. Retrace where? To the equilibrium of that range from this high to this low. Price came above 50%, right above the 786 range. As long as it does not go past this 100 right here, this 1.1, that means it's still respecting the trend and it can now push down. It just has to come above 50% because these are the range where the institutions likes to operate. They like to inject large sums of money. That's why you see those big fast candles happen, is because the institutions are now getting involved. So this is how you understand that when it comes to your swing highs and your swing lows, you're not just marking any little structure, any little highs or high lows, high lows. You want to mark the one that led to something. So let's continue. So we went from this high, we're not going to say this low. We know we have this high that led to this low, but this is the swing high, the originating point that led to this low. Okay? We'll talk about these types of zones later on. This is what you're going to call your decisional, but we'll talk about them later on. So then let's continue. Excuse me, that's the wrong one. So we back again. This was our lower low, lower high. This is not a lower low. This is not a lower high. Right here would be our next lower low because now we're back into this trading range from this high to this low. And what did the market do? It broke structure. So what must happen next? Price must retrace. So now what has to happen next is the market has to retrace. Where does it need to retrace to? This is where we talk about. You need to use your fib tool and find the equilibrium within 50% range and above. Now, this is just giving you a blueprint of where to expect price to come. That doesn't mean that you're going to find every order block in that range and take trades from each one of them. No, we'll uncover that later on this week, where I'm going to bring you to precision. I'm going to bring you to the exact point. We're going to go through this in theory on the chart where you're going to be able to see it in action. But right now, what I just want you to have is the basic understanding of the ones and twos of the market. This is literally how the market operates. It changes character, it breaks its structure, and if it's just continuing a pattern of break of structures, after it breaks structure, you might come into the market the next day and the break of structure already happened last night. So guess what? You opening up your computer, all you're coming into is the retracement. So you're either going to be buying up to the equilibrium, or maybe the retracement had already began, and when it's your key time window, you're now positioning yourself to sell back down again. Or maybe you're coming into the market and this is the leg that's about to break structure. So it's all about knowing where you are in the market that's going to allow you to not fall into the wrong side. So right now, you can easily see this swing high, this swing low. These are how you mark your swing positions. As you can see, high, low, lower high, lower low, lower high, lower low, lower high. You find the lowest point. You found the retracement point. You find the lowest point. You find the retracement point. So a swing high, for example, you will not find a point higher than it to the left. So as you can see here, so to give you clarity, a swing high and a swing low will not have a high. So for example, for high, a swing high will not have a previous high to the left of it, and a swing low will not have a swing low lower than it to the left. So for example, as you see here, this swing high will not have a high to the left of it. This swing low will not have a swing low to the left of it. Same thing here. This swing high, there's no swing high to the left of it. This is the higher high. So this lower high, there's no swing high above it. I mean next to it. Above, but not next to it. Same thing as it continued. This swing low is lower than this previous low. So there's no swing low that's lower than it. Same thing here. There's no swing low that's lower than it. Until obviously it gets broken, that's when you have the next range. That's the whole point of before it got broken, it was the swing. Then it got broken, then it continues. The price action carries on. So this is the better understanding of swing highs and swing lows. Understanding your dealing range, understanding discount and premium. In this case right here, this 50% range would be price coming to a premium, right? This will be you waiting for price, because we said now we must wait on price to retrace. We will be waiting for it to come to a premium in order for us to look for a sell position back down to break structure once again. So that's how that would be, okay? And then it will be now the next swing would become from this low to this high, from this high to this low, and then you would look for your equilibrium of this swing high and this swing low here, because the one from this one has already been broken. And then you'll do the same thing again with your fib. You'll find the equilibrium, because as you know, whenever there is a break of structure, the market must retrace. Okay? So that's all for this market structure foundation and price behavior. That's what I wanted to cover with just today. I don't want to give you guys too much to not to bear for you to process. Let's quickly just look at that quickly on the chart itself. And see the swings, so that way you can understand the concept of the swing highs and swing lows as well. As you can see, let's say, for example, in this bullish price action, as you can see, it's the same thing. We see this high, this low, this high, this low. We're marking these as the swing, and not, for example, not these internal highs, not this internal one, not these internal price actions here, not these internals, not these internals, because there are highs that are higher than them, and there are lows that are this high is higher than this high, and this low is lower than this low. So therefore, this is only internal price action, which we will cover into later on in the week, external and internal structure. That is something that you will also need to understand, because from what we're looking at is a daily. When you get to lower time frames, once we start getting more into understanding how to find your entries, understanding how to narrow down to your POI, when I start giving you the basics of the strategy, because right now we're just uncovering the basics of, like, price actions and how the market moves, but we haven't really gotten into the strategy yet, which will be soon. By the time we get to day 2, day 3, we'll get into the strategy, and that's what's gonna add it all together for you, and it's going to make more sense, and you're going to see that trading is not as difficult as most people see, or maybe most people make it. It's more so you yourself. How disciplined are you to simply wait for these patterns? Simply wait. If you know that you're in a retracement, how disciplined are you to simply wait for price to come to the premium to then look for your sell? Or vice versa, if it's a bullish market, how disciplined are you to wait to take the buy from the discount? Or how disciplined and thorough are you to mark and understand your equilibrium, to understand your trading range, and to see where you are in the market, to know where price is headed to next? That's all trading is. Once you know that, the rest is just a matter of waiting for the opportunity and taking your shot. Okay? So let's take a Actually, let me ask you guys, do you guys need a break? I'm done with this session, or do you guys want to go into the Q&A? Let's You guys can unmute. Let's see. Unmute all. Okay, take a quick break. Yeah, I want a quick break, quick break. All right, guys, so let's take a quick 5-minute break. All right, let's take a quick 5-minute break, and then we'll do the Q&A. And we'll dive into that afterwards, okay? So quick 5-minute break. Let's stop sharing. Okay, so break. All right. Man, this sickness is killing me. All right, guys. Let's wait for everyone to come back. Feel free to unmute yourself when you have your questions. Let's try to keep the question based on what we just spoke on. If you need more clarity. And if some things doesn't register yet, be sure to rewatch these videos because that's when it will make more sense. The more you watch them, the more you show up in the market, see the charts, the more you'll start to understand it. It takes practice with everything. It takes practice. The more you show up, the more it'll be more obvious and simple. It'll make more sense. Okay. Yes, go ahead. Unmute your mic. You can ask the questions. Yes. Yes, yes. Go ahead, guys. Unmute your mic. Let me see. Let's go with Eunice real quick. What's your question for today?
Hello?
Yes.
Hello. Yeah, I have a question about sorry about my voice, about the premium and the discount. I just wanted to write a note like of the meaning and the definition because I wasn't able to do it at the time.
Okay. So you want to know the definition of premium and discount? Is that correct?
Yeah, yeah, like the meaning.
Yeah, sure. So for the premium is where you're waiting for the price when it comes to you're looking for a sell. The market is going to retrace to the premium range. Premium is where it's the best price that you could sell from. It's when the market is at a high price that you can sell from. The discount is the cheap range where you're waiting to buy from. You're waiting to buy the market up. So when you're looking for a buy, you wait for the market to come down to discount range. And all of that plays within your equilibrium, the trading range. So when it comes to looking at your trading range, if you recall, were you able to get a clarity on the trading range?
Yeah.
You, yeah, okay. So within your trading range is where you identify your premium and discount. Your premium will be on the top side, your discount will be at the bottom. So if you're looking to buy the market up, you wait for price to come to your discount, which is
Okay.
at the bottom. And if you're looking to buy the market, because let's say you had a change of character and a break of structure, and now you're waiting to sell the market, you now wait for price to come to your premium to look for that sell.
Okay. So the premium is where like it's the best like value to like sell from, and the discount is where you buy from.
Correct.
Okay, thank you.
You're welcome. Okay, let's go with Dub. Let's see here.
You can hear me?
Yes, I can hear you. How's it going?
What's going on, my brother? Hey, the Fibonacci sequence. Is what you said? I think that was the word.
Hmm.
Fibonacci tool.
Yes.
There you go. Yo, buddy, how do I get that? Like, do I gotta like? Is it some shit I gotta download, or I could just get it
No.
on my MacBook?
Yeah. So do you have Trading View? What are you using Trading View?
Nah, I was not using Trading View. I think I was using Trade Locker.
Okay, so Trade Locker is the broker. Trading View is where you chart. It's basically where you do all of your drawings, where you do all your analysis. So it's very important that you have a Trading View. Trading View, you can have a free account if you want, or you can do the basic account, which is about $12. But they always have deals that they have all throughout the year. Sometimes they do deals where it's like 80% off, etc. I would say get a Trading View account because on Trade
Yeah.
Locker, the fib tools that I showed you, the settings that I have, you won't have that on Trade Locker. Trade
Yeah,
Locker,
Pete, like all the shit you was doing on the computer. I ain't seen none of those tools. Like I seen some of them,
yeah.
but like not too much of them on my end. Like for me, off what I was used to seeing.
Yeah, that's because of Trade Locker. Trade Locker is more used for executing trades. When you're putting in your entries, you know what I mean? When you're putting in your buys, you're putting in your sells. That's when you want to use Trade Locker. It's not the best platform for marking out what's going on. It's not the best platform for marking out what the market is doing or what it's telling you. It's mostly there for you to execute those trades. So that's what I would say for you to do, bro, is create a Trading View account. It's free. Just go to tradingview.com and just create an account and set up your platform. Even with this white background, let me try to share the screen again. You can easily set up your settings on TradingView as such. So hold on, the screen is gonna share. There you go. So once you create your Trading View account, it'll be like this, for example. Let me go to, where is it? This is what Trading View will basically look like right here. You sign up, you get you a plan. Can you see this?
Yeah.
Yeah, you sign up, you create you a plan. They have many different plans. I think right now I just use the basic. I'm just using the essential. So you don't really need the like all of this expensive one. I just do use the essential. I think when I got it, they had a sale. Like right now, they're doing a 17. They had a sale around Black Friday where it was like 70 something percent off. I ended up getting it basically at $9 a month. So I just did a whole year plan. So all the time
Okay.
sell. So you create a free account first, and then they'll send you a bunch of emails with sales. And then one day you'll see a large sale, and then you can just get one of these. The only reason you want to get one of the plans essentially is because of the time frames that these will allow you to go on. And it gives you what's called a bar replay. Bar replay just allows you to go back in time when it comes to back testing, which is something
Okay. Okay. Okay.
yeah, we'll go over that later on. But all of these other tools right here, you don't necessarily need them for how we trade. They're not that important. So once you just go to super charts, it just takes you to this right here. Um, and it's just like Trading View, Trade Locker. You just go to your settings and you can basically set up your chart. However, this is how I have my chart settings. So if anyone wants to have the similar, these are what I use. This is my chart setting for my bodies. For the borders, I just use these for my candles, for the wicks, etc. Yeah, and this is just pretty much it. This is just what I use for the background. I just use white background like this, and it's pretty much my settings. So yeah,
All right.
try to get your Trading View, and then if you want, do your settings, and then once again, I'll show you the tools for the Trading View. For the fib, and then these are your fib tools right here, and that should get you. You should be good once you have that.
Appreciate it, my boy. Thank you for the feedback, man.
For sure, man. For sure. All right. Any other question, guys? Any other questions? I'm going to upload this video as well. Um, I'll drop the link in our chat once I upload it, whether I upload it on WAP or YouTube. But I'm trying to keep it simple so that way you guys don't have to keep going so many different places. So as soon as I upload the recording, you will know something you can go back and review. Tomorrow, we're going to go over liquidity in the market. So we're going to speak about the supply and demands. We're gonna speak about how to mark out your supply and demands. So we're gonna bring all of this that we spoke on today. We're gonna now go a step into it. So now that you know the equilibrium, you understand that price is coming back to your discount or your premium. Now we're gonna go into how do you mark out the zone in the discount that you're gonna wait for price at, or the zone in your premium that you're gonna wait for price from. So that's what we're going to speak more about tomorrow. We're also going to go over order blocks. What are order blocks? What do they define? How does it look when you're marking out your supply and demand? What type of order block pattern you want to see? So we're going to cover that tomorrow and put it all together. So yeah, within this week, we're going to put it all together, guys, and you're going to have a clear understanding, the basic understanding of trading. And all you're going to have to do is just practice daily, and you're going to see how easy and second nature this thing is. It just becomes you versus you after that. How patient are you? How disciplined are you? And you realize it has nothing to do with the market. It's just you versus you. All right. If there's no other questions, guys, I appreciate y'all showing up for this session. I'm going to go ahead and commence the call and upload this video. Okay, hold on. We have one question from Eunice. Let's see. What's the question?
Yeah, sorry about that. I have one question. Is there any like homework or anything like that?
Yes, yes. So the homework that I gave you guys earlier was from the slide. I forgot you said you weren't there in the beginning. But the homework was this right here. I'm going to share it on the screen for you guys.
All right.
This is all I want you guys to do. If you took notes, guys, if you did not take any notes, you are wasting your time. There's no way you're going to remember all of this through memory. I'm telling you, I've been doing this long enough to know that there's no way you're going to know this through memory. You have to study, you have to review, you have to read your notes. I can show you, I have over 3 books, 3 notebooks of notes that I've been taking during the period that I'm learning from my mentor all the way up till now. So I'm telling you this for a reason. Okay, so let me get that all up here for you. So the homework, this is what I need from you guys. I need you to, let me share it. This is what I need from you guys. Okay. I need you to practice reading the candlesticks on a chart. Whether it's tonight, whether it's tomorrow, because the market opens in the morning, pay attention to the things that we spoke about today. Look and identify those market structures. I'm going to give you now the time frames that I want you to focus on for now. Focus on the daily, the 4-hour, and the 1-hour. That's it. The daily, the 4-hour, and the 1-hourly. For now, just those 3 time frames. You don't need to go on the weekly, the monthly, the 30 minutes, the 15 minutes. You don't need to go on that yet. For those of you who are very new to trading is why I'm saying this. Take it easy. Go on the daily, the 4-hour, and the 1-hour, because that's where you're going to be able to identify the market structure the way that I've been showing you. You're going to be able to identify the trends. I want you to go in and look and see if you can identify some of the trend based on what I've showed you today. Higher highs, higher lows, lower highs, lower lows. See if you can identify slight change of characters and breaks of structures. I just want you to practice seeing these things. Don't take no trades. Don't go do anything crazy. Just see if you can train your eyes to start recognizing these things on the fly. Secondly, is what I said right here, identify the market structure in real time. If you're able to show up in the market during the live market, see these things. See the trading range. As you know, the trading range is the last high that led to the low that causes the break of structure. See that equilibrium of that trading range. Mark out the trading range and wait to see how is price going to retrace to that range. It's none of your business how long price takes to get there. Just focus on, okay, I know that this break of structure happened. And from what he said is after a break of structure, price must retrace. Let me see when this retracement is going to come. And he did say it has to come to the equilibrium from this high of the fib to this low where it reached. It has to come 50% or above. Let me see if it's going to come to this range. And that's all. You start doing it little by little like that until we finally get all of this together throughout the week. Then it's going to be crystal clear for you. So this is the homework that I want for you guys for day one. Just do that. Review your notes, develop the understanding of what I've showed you, and practice reading those candles from what I've showed you today. And that's it. And I'm going to upload this video as soon as possible, if not tonight. So that way, if you guys need to review it tomorrow before our call, you can do so. So that way it's fresh in your mind. And then when we go into the next subjects on the call, it'll all connect. The way I have it structured, it'll all connect. It will all connect and make sense. So that way, when it comes to you going in the market practicing, you're just going to be taking step at a time. Okay, step one, I do this. Step two, I do this. Step three, I do this. Step four, boom, boom. Okay, now I just wait. Price comes there, I do this. It's going to be that systematic. That's why I say trading is easy. It's very much a system. It's systematic. It's just you, your emotions, your impulses that cause you to do things that you shouldn't do because you have FOMO. People may have fear of missing out. Price make it look like it's leaving, but really it didn't even come to your zone yet. But you think, oh, it's not gonna come to my zone. It came so close and it left. I have to go. You chase it, and then it comes back and take you out, and then actually reaches your zone. And now you don't already lost. You fear that it's not gonna hold your zone, and then it does, and it causes a lot of psychological problems. So that's really what trading is. It's more so you only versus you. But we'll get deeper into that another time. Any other questions, guys, in regard or questions in regards to the homework? Anything that I can um, explain further? Okay, so all right, cool, cool. So it looks like we're good. Once again, thank you guys for another opportunity to give you guys some understanding of this market. So we'll talk tomorrow, and I will upload the link as soon as I have it for you guys to review. And if there's any questions, feel free to message me in the group chat. And that trading floor, this is us. That's only us in there. Feel free to communicate, guys. Message in there. This is direct access to me on questions you have about the market. For those of you who are new, you may feel a little bit timid. You don't want to communicate in the other group chat where all the other people are who knows that's trading already. Maybe you're shy. Use the trading floor where it's just us, the beginners. That's why I made it a small group of mostly people who are not that does not advance in trading. So that way you don't feel that way. You feel, you're in a room full of people who's trying to learn at the same level as you. So be sure to use that, communicate, message, and yeah, let me help you grow. All right, guys, without further ado, I'm going to end this call and I will see you guys tomorrow.